So today on our podcast, we actually have Andrew Levitt, who is with West Coast Mortgage. And how are you doing, Andrew?
Can't complain. How about you?
Good, good, good. So I thought it would be a great idea to have a little episode on reverse mortgages. Lately, you and I have been doing a lot of work with folks, and I think that it would be great if we could eliminate the stigma that was associated with reverse mortgages in the past. Maybe provide an example of when a reverse mortgage would make sense and talk through some of those numbers.
The data I think really is where it makes most sense for people once they finally have that aha moment. At the end of the day, the math doesn't lie. And so if you're seeking a reverse mortgage or you have no other options and you don't want to look at reverse and you're thinking about selling or letting the house go into potential foreclosure situation, the reverse mortgage was designed for the elderly, essentially once you've reached the age of 62 or higher. What it was designed to do is to remove the housing expense payment and let that housing expense payment go ahead and go to the next biggest bills for most senior citizens, which is usually medical expense and costs. And so, if 35% of the average person income per month is the house payment, you can take that element out, keep the home still, keep your equity still, and go ahead and now have that freed up to go and take care of anything else that comes up in life. That's what the design of that program was for. And it was built for those that made principal payments to their house, that made the house get either paid off or bring down the balance to where it's in a very low position. You should be able to use that as part of your retirement vehicle.
First of all, Andrew, I just want to say that since I'm nearing 60 myself, I don't like to think about 62 as being elderly. So I'm just going to start there. Um,
You don't look it.
but one of the thank you. These Zoom filters are fantastic. So one of the things that people, when I start talking to them about the reverse mortgage, they're like, but hold on, I want my children to inherit the equity that I've built in this home. So can you talk a little bit about the equity and, the inheritance factor?
So, essentially, the first and most important thing you got to think about when someone's going into reverse mortgages, it was designed for the borrower and or that homeowner is going to be in there. If you look at the statistics currently for the average American in the United States, 99%, that's not an exaggeration, that was a statistic that was published by Forbes, are people are either underfunded or don't have funding for their retirement once they reach that age. And so that was the design of the reverse mortgage, was to fix that need. You have to remember with a reverse mortgage, is the balance going to be increasing each year? Yes. But so does your appreciation. And the appreciation keeps on pace and in most cases actually outpaces what that balance increase is. And when you get to that maturity event is what it's referred to, or when that person eventually passes and the house does move on to the next of kin, there's still a very large chunk of equity that's still there.
So basically, when you're talking about the balance of the mortgage, if they still have a mortgage, right?
Mhm.
So they have a balance that keeps going up, meaning their equity is going down. But because the equity is actually increasing with time, because real estate increases with time, I think you've mentioned like 5% a year.
So there's two stats that you can look at. One that has a bigger view or longer time frame, and one that can be a little bit more recent time frame. The longer time frame is going to be since the inception of the mortgage industry. Mortgage industry was established in 1937. Fast forward to today, it's 88 years later. Over the 88-year span, through the Great Recession, through 2008 financial crisis, through all the ups and downs, housing appreciation has always been a little bit north of 5%. If we go to the year 2000 and forward, it's actually been closer to about 11%. The example that we're going to go over today when we get to that point is going to be based off the 5% level, just so you can see at the worst, most conservative case, what does that equity appreciation actually look like versus what that balance is doing over a 10-year period. So the average person, in most cases, they don't have retirement built out. They don't have enough saved. And so they usually do own a home though, and they've paid on that home for the last 30 plus years. And because they've done that, it puts them into an equity position where this is an actual option for them.
They have saved in a different way. They might not have saved for retirement in the traditional way of the IRA, but they've saved and they now have equity in their home. And so they have more than they think they do. I think
Yep.
that was the whole point. And they can do something with that equity and they have choices. And the reverse mortgage gives them a choice as they go to their next
Yeah,
chapter.
and that's the best way to put it. At the end of the day, if you haven't saved or if you don't have enough saved, you have paid on your house payment for the last 30 plus years. So you might as well use the equity that you have put away to go ahead and get through whatever the next event or next chapter in your life is going to be. The average person, oh my God, come on, get it together.
So I want to talk about some of the folks that you and I have been working with, right? So we have been working with folks that probably the average age of people that we've been working with together around between 70, 73 years old, right? They're either in a home with a very low mortgage, either A, they need to sell because they need to get a one story, they can't make those stairs anymore, or for whatever reason they can't afford that mortgage, and you want to eliminate that mortgage for them so that they can use that money with their social security or their other retirement income to actually live, right?
Correct.
So if you want to talk about examples, I remember when we first started talking about this, if you said you do about 2 reverse mortgages a month, right?
I'd
Can you
say
just tell me, give me some examples?
yeah, so on average, at least 2 to 3 months, on a given basis. And the only reason I reference the production on the monthly basis, I'm very fluent with the program. So the reverse mortgage itself, it depends on how you want to set it up, and how you can set it up depends on the amount of equity position that you have in the property. It can be set up in a couple of ways. If you're not on the higher end of the equity position, meaning that maybe you're right at the minimum, at the very least, it's going to go ahead and remove that housing expense from your monthly budget. In the event that you have more equity, or maybe even the house is paid off, you can set it up to where obviously there's not going to be a house payment going forward once you take the reverse mortgage, but you can also set it up to where it gives you a monthly stipend income. It can go on for 5 years, 10 years, just depends on how much equity and how fast you want it to be used. And in those cases, essentially, even if you go to the max distribution of what the monthly income is, it's set to a limit threshold to where you can't outpace the appreciation.
It's not a common thing. It's an option, but it's not common.
I would say out of 10, maybe 3 or 4 will do it.
Okay.
What people have to remember at the end of the day, the bank never loses when it makes a program. The bank always has to win. Good financial outcome for the bank and for the borrower. And so if that equity was just to get extinguished completely, well, then the bank would lose, and the bank would never do that kind of a product. So at the end of the day, the bank's going to make sure the math solves for them. And that because they do that, that also means the equity just doesn't go away.
What's the lowest equity percentage that you have actually done a reverse mortgage for?
So it changes based off of the age and based off what the current interest rates are. To kind of give you a comparison, let's go back to the year 2020 when rates were at 2 and 3%. Back then, you only needed 50% equity into the property. As rates have moved up, it's moved closer now to where you need about 60% equity into the property.
Let's pretend that they lived to 110 and depleted their equity. Tell me about what happens and what the children are entitled to at that point.
So, and that's the coolest part is, they get to 110, there's still going to be equity in the home. It's not going to be depleted. What's very unique about a reverse mortgage is it has a next of kin element. So, let's say that you pass away, and when you passed away, you didn't have a trust or a will set up. That means that house is going to go to the court system. It's going to go to something called probate court. Probate court by itself is going to cost the average person about 11 to 15% of whatever the total value of the assets are. With the reverse mortgage, with the next of kin element set up to it, what happens when that person has that maturity event and they pass, that it is going to notify whoever the next of kin that was designated on that loan at that time. The bank is then going to send them a notice saying, hey, you need to go ahead and pay off this house, and you can either decide to sell it or you can refinance it into your name, but we need to go ahead and resolve this balance that's on the loan.
They can purchase the home for the amount that the mortgage is left.
Correct. In all cases with a reverse mortgage, you're still going to have that equity position left because, again, the calculations of how it was set up was designed to make sure there's equity still left at that endpoint. Okay, so year one, it starts out at 200,000. We're going to add the payments that they're not making, so the balance jumps up to be 216. Go to year two, it's at 216. It's going to add the same 16,000 again, so you're going to see it grow each year by about $17,000. Now the appreciation is doing the same thing, but the appreciation continues to grow because it's based off the actual asset value of the property. And so even if you get 10 years into it, well, the balance, yes, has gone up by $152,000, but the equity has also gone up by almost nearly half. And that's how it continues pace. And that's why, mathematically speaking, it can never extinguish or deplete the equity. And it doesn't really matter how far you go out with this. If someone ended up living to be, 20 years afterwards or 30 years afterwards, it's going to keep on doing that. It doesn't run out because it just mathematically can't. Most people, when they get to the age of 62, are relatively in good health, and they usually continue working until the point where they can't. And that's the key part. So maybe you work until you're 72, 73, but you just physically can't keep going at the 8 hours each day. And maybe it happens sooner than that age. Or in one of the clients that we're working with right now, you have a massive medical event in the case of a stroke or a heart attack. And you physically can't work because now, after surviving that event, you're in a position to where you just can't do what you used to. Or if we go to the more common reasons that maybe you are going from a 2 level down to a 1 level house and you need to go ahead and get it to where it's a little bit easier to get around. Or perhaps that you need to move closer to your grandkids because you want to be with them. They're in a different state. What the reverse mortgage is going to do is it's going to take the equity position that you have in the existing home. So that way you can sell it and then you can go ahead and do what's called a reverse purchase. You just buy the next house and you put the down payment there. And because you're using that equity to put the down payment on the next one, you still have no mortgage payment.
When would you say it's not a good idea to do a reverse mortgage?
I mean, if the house is paid off and you don't need any income in each month, then that's a great point to when you don't need to do one. Usually, the reverse mortgage, it isn't really one of those questions that you sit down and have the conversation of when you should or shouldn't do it. Usually, when you're at the reverse mortgage point, there's a need that can't be satisfied from any other assets that you have in your possession, whether it's the down payment, whether it's retirement. It's usually the lack of funding, and the only funding that is left is typically the equity or that house that they have, or they have a large sum of money that they come into play with, and they want to buy something that's closer to the kids or whatever the applicable reason is. They don't have enough to buy it outright, but they could probably get close to half. Those are usually when that conversation comes up in play. Reverse mortgage is a very protected category, similar to VA loans. Rules and safeguards that are put in place on these mortgages to ensure that when we're going to have this conversation, we're going to be fulfilling the.
Okay, that definitely makes sense.
If you find yourself to be at a position where you have no options, but do have equity in your home, or you have a large sum of money and you're getting told that you don't have options, either from a lack of income, from a lack of the ability credit wise, the best thing anyone can do is to get 3 or 4 different opinions from different loan officers. And even if I'm the first loan officer you talk to, at the end of the day, if you talk to more than one professional, you're going to learn something from each one, and make sure that you get those opinions before you make a decision that's going to affect the rest of the way you live, financially speaking.
Tell me about the credit score. How does their credit score play a factor? Because a lot of people they get they sort of make quick decisions that may not be right for them because they think their credit score is more important. Go ahead and talk about that.
So the biggest benchmark to get out of the way, you don't need a 620 credit score. FHA requires a minimum credit score of 500. What the FHA has set the credit underwriting requirements as is it's based off of the actual house itself. It's based off of what the equity is going to be in the house. It has nothing to do with your ability to repay the loan. And that's what credit score measures is essentially your ability to repay whatever the obligation is. And the reverse mortgage doesn't have an obligation. And that's why essentially it doesn't matter what your credit score is, you're going to be able to qualify based off the equity position of the home. It's based off the math and the house, not your ability to repay. At the end of the day, if you have the equity position, that's what it's looking at more so than the credit score.
Okay, let's, for example, say I own a home and I don't want to pay my payment anymore, but I have a huge equity position. Does that make sense? I can potentially refinance my home using a reverse purchase. Is that correct?
It is. So, the first step when you start thinking about reverse mortgage in any aspect is it's not so much really an appointment to do a loan application, do the loan documents. It's really the first appointment's about financial planning. What do we need to plan for? What's happening currently? Based off what's happened currently or in the past, what do we need to anticipate that's coming up? So a good example would be to use for the client that we're working with right now. He's had a stroke. He's had several of them. And the point is that in that conversation, we learn, okay, we have a medical event that's happened in the past. We have a medical event that could be coming up into the future. Okay, we need to plan for that, and we need to make sure that we have the ability to get through that financially. Um, it really is a full encompassing view of what's going on currently. What do you need to accomplish in the next 5, 10, 15 years? What's your perfect world end goal? And what can you live with end goal? And then from there, we figure out, okay, which reverse product makes the most sense? For those that have a financial advisor, we get them involved so that way they can be a part of the financial planning. And from there, we go to our next step.
When would they need to consolidate debts versus not? When would you keep the debts separate from the reverse?
So with a reverse mortgage, because there's no housing payment, that's also not included into the debt to income ratio. That usually makes people that only have Social Security, perhaps that they're surviving on, still able to qualify because if there's no other obligations, car payments, credit cards, or we can consolidate them into a loan, well, now they can qualify even just being on Social Security. So it just depends on what the monthly income is. If your only income is Social Security, chances are we're going to need to pay off the debts. If you have income from pension and you got Social Security, then you're probably not going to have to pay off the debts. In cases where we don't need to pay off the debts or where you shouldn't, is if there is a simple interest installment loan. So think of like a car loan. If your debt to income ratio can qualify with the car loan, keep the car loan at 8% or 7% because it's a very simple interest loan. You're going to pay only 10 to 15 grand on the interest for the entire life of the car versus throwing in mortgage worth a compounded interest product. So where they can and where they can qualify, we leave out simple interest debt. And where they have credit cards, that's at 29 and 30%. Yeah, we're going to consolidate them because you're going to win way more by getting it paid
Mhm.
off now versus rolling into the mortgage
That,
and paying it separately, or
that
not
makes
rolling into
sense.
the mortgage and paying it separately.
What if you have a couple that, like you said, they might have medical challenges and, they want to make sure that if in 5 years from now, they can actually go into assisted living. How does that work if they're in a reverse mortgage home?
So I see you're saving the best question for last. When we get into a reverse mortgage, this is probably one of the most important things, if not the most important element about a reverse mortgage. It is the only product of its kind in any country or any financial system that doesn't have a recourse element to it. So what that translates to is as long as one person is going to be in the property out of the two spouses, whether they go into assisted living or whether one of them passes, the other spouse can survive the loan. They still get to stay in the property with no housing payment and no obligation to it. When you get into a scenario to where one is going to go into assisted living and they need medical care assistance around the clock, in those particular cases, if you need the financial money to go ahead and afford that, that's where we can look at using the equity again and doing a refinance of that reverse mortgage, pulling out the money that you need to go ahead and get it started. Is it enough to cover the assisted living? Well, that's going to be your answer, and the math will show it at that time. But for someone who got into a reverse mortgage at 62, goes into assisted living, maybe at 70 or 68, that house has been appreciating that entire time, and the appreciation's been faster than the balance has been growing. So it's still going to build equity that you can access later when you need to when that event happens.
Okay, so if they got to a point where the equity position, it was not enough equity for them to draw that money out every month, then at that point they could make the decision to sell the home.
Yes, and that's the best part about it is at the end of the day, I can give you my financial opinion looking at it, but the math is going to say what the math says. If the math makes sense to where you can do both, perfect. That's the perfect outcome. But if the math doesn't work out to where you can afford both or do both, then that's where you look at the possibility of selling the property. And that said, even if it gets to the point where it doesn't make sense and financially you still have to sell the property, there's nothing to say, just take out the equity that you need to go ahead and pay what you need to pay, but go buy a condo with a reverse mortgage. Get a very small or cheaper expense so that way one person that is not in the assisted living can still have a residence, can still not worry about a house payment, get the access to the money that they need, take care of the medical event that happened or the assisted living costs, and still have a contingency plan for the next 10 to 30 years after that.
Okay, thank you. Well, Andrew, is there anything else that you would want to talk about regarding reverse mortgages? I've learned a lot here. I'm sure our clients have learned a lot as well.
You know,
Anything that Tom Selleck would not tell them about reverse mortgages?
Tom and I'm going to put them in the same category as I put David Ramsey. Um, their plans work for a lot of people, but you need to see what the math says for your personal scenario before you make a decision. And you should never make a decision without knowing all the data and the facts.